with this 187,000 gain in jobs, I've been trying to dig through the industries here to see where the shortfall could potentially be. Employment in professional and business services was down 8,000 in the month, and temporary help services, temp jobs, continuing to trend down by 22,000. Temp jobs are seen as a potential leading indicator for the rest of the job market. That's something to continue to watch. And then there was little change in a number of other industries like mining, which has been sort of moribund for a long time, oil and gas extraction, manufacturing, retail trade as well, and transportation and warehousing. So some interesting trends here that we are looking at in these numbers. But let's get some perspective now on these. We're now joined by Stephanie Roth, JP Morgan Private Bank Senior Markets Economist, and Aditya Bhave, who is Bank of America Senior Economist. Thank you so much both for being here. Is it sort of a wash in a way? Aditya, I'll start with you because you did get that wage growth that was a little hotter, but the overall number a little worse.
I think this is a solid jobs report. The 13,000 miss was relatively mild. The 50,000 downward revision probably a little bit more significant. But at the same time, as you said, wages were pretty strong and they beat expectations. And the household survey also was solid. I think it was up 268,000, unemployment rate down. So we've been making the point for a while that the household survey has some catching up to do with the establishment survey. The fact that that's happening in the right direction rather than the establishment survey moving significantly downward towards the household survey, again, points to a solid job market. So big picture, we're still printing multiples of what break-even is, which is about 75 to 100,000, which means we continue to tighten the labor market rather than ease it up.
Stephanie?
Yeah, totally agree there. The jobs market was pretty solid in the month. The establishment survey was a little bit softer than the household survey. But overall, the picture is pretty good. And by the way, we kind of want to see a softening in the labor market. That's what the Fed is trying to achieve. So the fact that we saw a little bit of a miss there is not necessarily a bad thing. And on average hourly earnings, it's not really the best measure of wage inflation. We got, ECI out just a little while ago, and that showed a labor market continuing to soften from a wage perspective. So that's really the gold standard when it comes to wages. Average hourly earnings are a lot more noisy. So I would say it's solid labor market, but signs of cooling to some extent.
Well, then let me just ask you to follow up on that. What do you think the Fed is thinking right now? Jerome Powell, looking at these numbers.
I think he's probably feeling okay about that. Granted, before the next meeting, they have another 2 CPI prints and another payrolls print. So this probably doesn't really change the view from what's going to happen at the next meeting. They have a lot of data between now and then.
Stephanie, is this a perfect job support for the markets? To me, I'm very surprised the markets have held up the way they have this week, especially off of that credit rating downgrade, but not too hot, not too cold.
Yeah, I think from that perspective, it's a kind of a Goldilocks print outside of the average hourly earnings number, which was a bit strong. The thing is, what's been driving rates for much of this week has been the long end selling off, unrelated to expectations of what's going to happen from the Fed, more about a term premium issue.
Aditya, your team made some headlines this week by changing your call for a U.S. recession, saying it's not, you thought it was going to happen, now you're looking more for a soft landing.
Yep.
Walk us through that and talk to us about whether this report helps support that thesis.
Right. So the simplest way to think about it is that several weeks ago, we were looking at 1% roughly first quarter GDP and probably looking at another 1% in the second quarter. Then the first quarter got revised up to 2% and the second quarter printed at 2.4%. So the outlook has changed significantly. We went from an economy that was clearly decelerating to one that's holding up just fine and potentially slightly accelerating with housing and manufacturing potentially finding a bottom. So for us, it's always been the trade-off between uncertainty, particularly around credit tightening, versus very strong hard data. And at some point, as the hard data continued to impress and surprise us to the upside, we had to put more weight on that rather than the uncertainty. And I don't think this latest jobs report really changes our view. We knew the labor market would decelerate, as Stephanie said. That's good news from the Fed's perspective, but it's certainly not rolling over. 180,000 is perfectly healthy. And as long as that continues, we think the economy still can move towards a soft landing.
But does it continue to slow down from here? Next month, are we at 100,000 or does it reaccelerate?
It probably continues to slow down. It's, of course, the pace of the slowdown that matters, right? If we quickly crater towards zero, then it's a very different outlook from what we expect, which is a gradual slowdown towards 150 and then 100.
Aditya, what do you think about the yield curve, the long end racing up? We actually have a lessening of the spread between the 2 and the 10 and the short end and the long end. So the inversion is shrinking. You think it's possible that the long end simply races up? And I've heard some hedge fund managers, some famous one on Twitter, saying, well, we could eliminate the inversion just by the long end racing up. Do you think that's possible?
So that is not the forecast of our rate strategist. As Stephanie said, the move in the long end this week has not really been related to Fed expectations or what's going on with the economy. It's probably more related to the downgrade, right? But certainly, obviously, you've erased some of the inversion. We never thought of inversion as necessarily a signal of recession, more of a correlation story. So again, that doesn't really change the outlook from our perspective. Of course, if rates remain high for a longer period of time, then I think that creates some rollover risk in terms of credit.
If we're looking at a few more months, Stephanie, of slowing job gains, does it pay off now to get more defensive with your portfolio?
Yeah, we've been defensive in portfolio positioning for much of this year. We've been telling our clients to add to bonds, but that doesn't mean that the clients should be staying away from stocks too. We actually think that you could get a continued grind higher, especially in line with your view, Aditya, that actually the potential for a soft landing is getting to be a bit more significant. So for clients to be sitting on the sidelines with cash doesn't really make sense. So we do think that clients should be adding into equities here as well. And we're a little bit more cognizant about valuation, so we're talking more about mid-cap equities where you have the potential for upside and the valuations are a lot more attractive.
Guys, we mentioned the downgrade sort of in passing, and while I have you here, I do want to get your take on it, because here we are looking at an economy that seems to be still growing, might avoid a recession. That's a scenario that gives us a little more leeway when it comes to things like U.S. debt, right? And the scenario that Fitch painted this week. But at some point, the U.S. economy will go into recession. We don't know when, but inevitably it will. And at that point, then maybe it becomes a little more problematic, the debt situation in the U.S. Like, how should people be thinking about this? We tend to be short-termist as humans and as investors. But how do we need to be thinking longer term? Aditya, I'll start with you on this one.
Right, so there is a concern about the level of debt. It's probably more of a medium to long-term concern. But the good thing for the US is that ultimately the dollar is the world's reserve currency, and that doesn't look like it's changing anytime in the near future. So betting against that will be very difficult from a market perspective. But for sure, deficits are blowing out. We don't see any signs of that reversing, and it'll get worse as and when we have a recession. So it's something to watch for, but I would say it's more of a medium or long-term concern rather than a near-term market concern.
What about the strengthening U.S. dollar? That pose a problem for you?
The strengthening of the U.S. dollar is probably a function of the fact that the U.S. economy is outperforming the rest of the world. So it's probably a little bit of a headwind for the U.S. economy, but I would think of it more as effect rather than cause, if you get what I mean.
Well, and on a similar note, it's been interesting this week to see the dollar continue to strengthen, right? Like, what, even in the face of that downgrade, the action in bonds, like what is all of this telling us?
Right, so how could we be worried about the dollar losing its reserve status while at the same time the dollar is rallying? So I think this just tells us that investors are still flocking towards a safe haven, which remains to be the U.S. So the concern about the U.S. reserve losing that status, I think, are overblown. And investors have been telling us that this week. And in light of a Fitch downgrade, the dollar is still rallying. So yeah, this is a medium-term concern. This might slow out and crowd out discretionary spending over that medium to longer term, but it's not necessarily a concern for the next couple months. And Fitch downgrading the U.S. doesn't tell us anything we didn't really already know.
What do you think would take down stocks? Is there an event or something on the horizon you're looking at for that could lead to a pullback?
I mean, now expectations are on the more optimistic side, so it could be any small thing that would rattle investors. You're starting to get sentiment moving towards that optimistic side. What that might be, I think there's a long list of things that are potentially could surprise the markets, and everybody in the markets are generally really quite complacent at this point. So it could be sort of any negative news that would really scare investors.
And what about market volatility? Aditya, please field this. The VIX, and if we can go to the Wi-Fi Interactive, VIX is elevated from its pretty low levels. We had trading all the way down to a 12-13 handle. You take a look at the bond market, the ICE BofA Move Index, that's finally ticking back up higher. Does this concern you, especially given the fact that bond volatility has been such a problem for risk markets when it's elevated?
Right, so volatility, at least in the VIX, is still pretty low by historical standards. The move up is probably a function of, the downgrade news, so not hugely surprising. Again, I mean, if you step back and look at what's happened this year, the move in markets has broadly been very constructive, and I think it's consistent with the strength of the U.S. economy, potentially some good news on AI. So not a huge concern from my perspective, because from a broader lens, it really doesn't look very problematic.
So to end us out here, I want to circle back around to jobs and look ahead. With the current framework that you have and with your revised forecast, where is unemployment going to peak out during this cycle, do you think? You first, and then Steph.
We have it in the low fours, around 4.3, 4.4.
So pretty much around where it is.
Very benign, very benign.
Yeah, we have it about 4.25, so very similar. So we do think that the unemployment rate should rise. That's what the Fed is looking for. They want to see some softening. But it's very possible we'll get that rebalancing with just a modest rise in the unemployment rate.
All right, so not too much higher than where we are right now. Thank you, guys. Really appreciate it. Stephanie Roth, JP Morgan Private Bank Senior Markets Economist, and Aditya Bhave, Bank of America Senior U.S. Economist. Thanks to you both. Appreciate it.